What's up, guys? Sam here, and I'll be doing the premium video for Friday, January 3rd, 2025. So, I'm going to be stepping out of the office here in a bit, so decided to just get the video out as soon as possible. I don't expect too much to change here. It would take a really, really dramatic Friday to change anything in terms of what I'm going to show you. Some of this we covered in the live session yesterday, but because it's been one of those weeks where you had the New Year's on Wednesday, I believe, market was closed, and then light trade going into it, a little bit of light trade coming out of it. Things are a little bit messy out there. So what I'd like to do is basically kind of show you the main points of some things that I'm going to be looking at this weekend. And then on Monday, I'll have we'll be back to a normal schedule in the room as well. The market will be back to a normal schedule. Although next week, surprisingly, we do have Thursday off, or the market is closed, I should say. So let's cover the main points going into next week. And then on Monday, I'll present you with kind of everything that I've put together over the weekend. The weekend work is going to be pretty important. I hope that you're doing it as well, using whatever resources you prefer to use. But also keep in mind, doing weekend work this weekend will cover you because we had, as of, just a couple of days ago, we have a new monthly candle that has closed. The December candle has closed. And if you look at something like the NASDAQ, it's an interesting candle to say the least. And then you also have a yearly candle that's closed. So it's always good to start the year, in my opinion, with those top-down perspectives. I wouldn't tell you to check a yearly chart pretty much almost ever. But considering it's a brand new year, you've closed the 2024 candle, it makes sense to put all those pieces together. We won't have time to do that in the video today. We're going to cover the main points, and then on Monday I'm going to share the work that I've done on the weekend with you guys so that we can all be on the same page. So with that said, let's go ahead and dive in. We're going to start here with SPY. I'm going to try to speed run this a little bit and then just try to cover as much as we can. So the SPY here on the weekly chart, it is still a bullish chart. It's a bull plus, not max bull, but it is bull plus. The reason it's not max bull is because you are getting some sell pressure to the downside there. It's not anything overwhelming necessarily. We've seen that before, and it's caught pretty much instantly within just a week or two. So you do need to see that again. At this point, we always have to be on guard. We can't expect that we're going to get arrows. But at least for now, that is kind of a little bit of a warning signal. A secondary warning signal that I would point out here is the fact that this is still extreme, and that's unusual. It's unusual for the indicator to be putting a down arrow and saying it's also extreme. Extreme means that there's another indicator that's running underneath it that has now crossed above it. You don't need to know that, but that's what it means. And then, of course, on top of that, we do still have a very strong trend, a strong MACD, and this one has actually gone into double extreme. So this combination of signals right here, these triple extreme, this basically means that there's not really a lot of room for error here, right? They're going to have to find a momentum surge at some point because it's unlikely to be able to hold triple extreme conditions once momentum is run out. For now, the weekly chart remains perfectly fine, but of course that's going to be the one that's the slowest to change. So we should then focus more so on the daily chart, and the daily chart is giving us a completely different point of view. So you can't see it here, but on another monitor to my right, I have the SPY hourly chart. And frankly, I could use the SPY 4-hour as well. And both of those are bear scores, right? Pretty solidly bear scores. So on the SPY here, you have a weekly bull plus, a daily neutral, and an intraday bear, right? So green, gray, and red across the three time frames. That is a mess. That is the definition of a mess. Of course, the cool thing about that is you can just use the daily chart and it kind of approximates that for you. Keep in mind the weekly is green, the intraday, which you cannot see, is red. You put green and red together. What does that equal? Like purple or something? But for the score, it equals just neutral. Think of it hot water and cold water. You mix hot water and cold water together. What do you end up with? You end up with room temperature water. That's what the daily chart is telling us. Anytime that this daily chart has gone neutral, I believe The only strategy I know to do when a daily chart is neutral is to shorten your time frame. That's really the only thing I know how to do. I think that if you're going to try to swing trade this long or short with a neutral daily chart on SPY, it can be frustrating, right? You'll have up days and then big down days, up days and big down days, and then by the end of the week, your position is unchanged. Whereas you could have been day trading, each individual day and potentially extracted money from each individual swing. So just to keep things simple, if things are neutral on SPY, I view that more as a day trader's market until things align. And considering the fact that on the intraday it's all bear, it would be day trader's market with a slightly bearish bias for now. So that's kind of the long and short on that one. Now everything we're going to look at on the other indexes is going to be basically the same thing. I just wanted to kind of give all of the descriptors to you early so that we are all on the same page. So actually not really much here to change on the conversation. If we look at the QQQ, it's exactly the same thing as the SPY. It is bull plus on the weekly, neutral on the daily, exact same score actually. It's a score of 2 out of 50, so that's just neutral. The one positive thing that I can say here with the NASDAQ that does make it better than the rest is that the intraday charts on NASDAQ are only neutral. They skew bearish, but they're neutral, whereas SPY is solidly bearish for now on an intraday basis. Conversation doesn't change at all. When you have a neutral chart on the indexes, the only solution I know for that, the only workaround I know for that, is to shorten your time frame and day trade the time frame that offers clarity until larger time frame clarity starts to develop. Let's go to the Dow. We won't spend too much time on Mr. Dow here. Probably will have a worse score, I would imagine, than the rest. Okay, so it does. You can see here that the scores are now starting to degrade as we progress across the indexes. The Dow is a 26, so that is just a neutral plus, but basically just neutral. The daily Dow is a bear, right? While the other two indexes we've looked at are neutral on the daily, the Dow is a bear. So I don't see a ton of edge here in looking at the Dow at the moment. The focus should still remain on tech because that is the best of the worst for now. Let's go ahead and wrap up the indexes here with IWM. So IWM, same kind of concept. Oddly enough, the hourly chart on IWM, which is the reason I got into that trade yesterday, is actually the best of the three from an intraday perspective. Now you'll note that the Dow and the IWM have basically identical weekly and daily scores. But none of this conversation really changes, right? The only thing that really we're speaking to is back to the original conversation around SPY and what to do with a neutral daily chart. And all of these charts are telling us one thing, and that is to shrink our time frames, maybe soften our position size some, look to day trade where there is clarity, and avoid the chop and the noise until things start to develop further. So that is the indexes there. Let's go ahead and move forward to, where do we go? Let's maybe look at bonds. So we're going to look at bonds with the ZN and also HYG really quickly. And a lot of this stuff looks pretty rough, right? So here on the bonds, ZN, again, maybe the market doesn't care about higher rates. I think really as long as the rates aren't moving massively up or down, I think it's fine. The only reason I want to point this out to you is that right now interest rates, or I should say bonds in this case, ZN, are actually max bear, right? So that's typically a heavy signal for the markets. It doesn't have like strong correlations. Like I wouldn't say it's like a 1-to-1 bonds up or bonds red, stocks red, bonds green, stocks green, but it doesn't help. Bulls here would prefer to have lower rates for sure. And then lastly, let's just kind of wrap it up with the dollar here. And the dollar just continues to be just an absolute monster here. Max bull across the scores. You can see it for yourself. This is working in line with what we're seeing in interest rates and in bonds. So higher dollar is a function of higher rates, and neither of these things are helping the bulls at the moment. The best way that I know to correlate bonds back to the market is not necessarily through ZN or the interest rate itself, but it's going to be through credit spreads, and that's going to be through HYG. So we technically could have skipped the previous two symbols because, in my opinion, the one that really matters for what we're trying to do, which is for the vast majority of us, is going to be looking to go long or short on the indexes or individual equities. This is what matters more, and you can see here for now, again, just deeply neutral stuff here, right? It's a neutral on the weekly with a slightly bullish bias. It's a positive 19. On the daily, it's a neutral with a negative 22, right? So just completely neutral charts here, not giving a whole lot away. There's not a specific side here that is winning. I would actually lean it bearish for now because you're underneath a red cloud, and the ZN is still bearish as well. So we looked at ZN or bonds. It doesn't matter if you look at bonds or interest rates, they're interchangeable. That is slightly more towards the bear side. Well, that's actually, the ZN is actually significantly more towards the bear side. The dollar is significantly more towards the bear side, and HYG is leaning slightly towards the bear side as well. Let's go to you know what? Let's wrap it there. Let's wrap this part of the conversation up there. I think that we're just going to continue stepping over the same places if we continue down this path. So let's put all the pieces together. Let's go back to where we started. We started with SPY. And frankly, we really could have just stuck on the SPY daily chart, right? I think a lot of this conversation, I think, is generally helpful. Hopefully it was for you as well. It's definitely helpful for me to kind of articulate this stuff to you guys. But if we just focus here on the right chart and notice that SPY is neutral, everything else that we've looked at is also confirming that fact, right? The indexes, the Qs were the best one from the inside out and the outside in. The worst ones I think might have been the Dow, and the SPY chart is just neutral. So again, we did the work on the bonds. It's neutral but skews towards the bears. The dollar's neutral but actually the dollar skews towards the bears. And the SPY is neutral here, and it skews, based on the intraday time frame, it skews slightly towards the bears as well. So putting a point on it, when you have a daily neutral setup, and we've said this multiple times now, and I'll say it one last time, the only solution that I know for that, the best workaround, the best way to find, best way to turn a neutral chart, which can be typically frustrating for swing traders, into opportunities, is to shrink your time frames and day trade more often. So there is clarity on something like a 15-minute chart. There is clarity on an hourly chart. Use those charts as your primary anchors instead of the daily chart until the daily chart either develops back into a bull setup or develops into a bear setup. And then you can start using that setup for swing trades again. But as it sits, my strong advice to myself, and you can choose to follow or not, but the strong advice that I would give myself here is shrink your time frames, day trade more, be willing to day trade a 5-minute chart if that's where the clarity is, and then just be okay with that. Let it shake out, and whatever the direction the daily chart wants to go, then that's what direction we'll go with it. Let's go to two other points here that I want to discuss. So that was kind of the quick overview of the indexes. The second point here is going to be right on something that we covered yesterday, which is going to be the 10-year 3-month yield curve. So I'd been telling you guys some scary stories about what I think happens next, and I put that on a hiatus for a couple of months because I was waiting for this signal to trigger, and this is my timing signal. So, of course, most of you have heard of the yield curve. It's most commonly quoted as the 10-year, 2-year, the difference between the 10-year yield and the 2-year yield, and normally that is positive, and for a very long time it was negative, which is an inverted yield curve. This is on the 10-2. That uninverted, meaning it went back to positive a couple months ago. That's not my timing signal. My timing signal is actually the 10-year 3-month, which is what we're looking at now. So why is this important? Well, the yellow line is the zero line here on the 10-3 spread. And I'm going to circle the times where it's been below it. So we have 5 times in the last 40 years that this thing has been below zero, right? The issue doesn't really develop below zero. That's kind of like pouring gasoline but no match. The match happens when it comes out of zero and then spikes higher, right? So the move below zero isn't necessarily the issue. It's the first part of the issue, I should say. The finishing touch for the issue is when it rips out of the zero value or below zero and then starts going higher. And of course, this was COVID, this was a great financial crisis, this was .com. I don't know what this was. This was like savings and loan or Japan or something. But these are all like historical moments in time, right? These aren't like little baby pullbacks. This isn't a 5%, 10% kind of situation. These are things that have gone down in history as major issues. And the reason I want to talk to you about it is because now, as of December, keep in mind this is my timing signal, as of December, we are now officially above zero on this spread. So if the last 40 years have any validity, and I do think they do, I don't think this time is different. I think that way of thinking is extraordinarily dangerous. But if this time is the same as before, and keep in mind also that the bond market is significantly bigger and smarter than the stock market, this is the start of something similar to what we've seen before, right? Now, don't sleep on this because the timing signal is now, right? Like I have not said that to you before, right? I've said, oh, keep an eye on the yield curve. It's a little bit dangerous, blah blah blah. But the timing signal is officially now. So, does that mean it happens tomorrow? No. But just keep in mind that this is kind of like a sword precariously hanging over the market, and and it just is something that you should be very, very aware of. So I'll go ahead and wrap it there because I think hopefully that just covers it. Just understand that this is a very dangerous signal. It is a very historically significant signal, and it's not a signal that I would bring you if I thought the market would fall less than 20% off of this signal. I'll go ahead and actually shoot completely straight with you and let the chips fall where they may. I think this is a 50% plus signal. So make of that what you will. We'll speak to it more as things develop, but understand that as of December 2024, the 10-3 yield curve signal has now triggered. That was the second point. Third, final point, the breadth in the market just completely blows. So this is, again, we're just there's a lot going on here. Just focus on the scores. The SPY is a 2, right? Now, typically we want to find things that are better than SPY. So where can we go? Well, from things that are better than SPY, we have very limited choices here. In fact, actually, SMH, surprisingly to me, is the only thing that's greater than a 2. That's not greater, that's not greater, that's the same, that's not greater, that's not greater, that's not greater, that's the same, that's worse, and that's worse. So oftentimes you'll have at least one or two sectors that are, bullish, at least neutral plus. Here, this is the best of the best is a positive 11 out of 50 that's just neutral. So there's not really a lot of places to flow into. Now, the places to flow into are still the same. They've just degraded to some degree. XLK, XLC, XLY, and now maybe we can re-include SMH for now. But also understand we're being extremely liberal with what we're including here. In most situations, I would actually say that we shouldn't even look at neutral setups, but just the quality of the image here is so poor that we look at neutral and say, oh, that's actually not too bad. So XLK, XLC, XLY, and SMH are pretty much the only sectors that are viable at the moment. And going into next week, I might put a little additional emphasis on SMH, just given the compression pattern there and the squeezes. And the fact that surprisingly it has the highest score of anything, but that is like being the cleanest shirt in a dirty laundry pile at the moment. So going back a couple things here, I think the index work kind of speaks for itself. Hopefully, the sector work here in front of us speaks for itself. I'd be curious to know if you guys see it differently. So if you do, email me or talk to me in the Monday session. We'll talk about it then. But where I want to kind of put a little bit of responsibility on your plate is on the yield curve signal that we just looked at. So when I show you this, don't take my word for any of it. Of course, I think it's not so much my word as much as just historical precedent based on the most liquid, important, smartest market there is, the bond market. But when I tell you this stuff, go out there and try to prove it wrong, right? Play devil's advocate against it. Why is this time different? Is the probably the question that I would ask you. Why is this time different? And actively try to disprove what I've told you. And if you can't, then you have an answer. And if you can, I would love to hear how that came about. So email me because I haven't been able to disprove it for now. So just wanted to go ahead and start there. First premium video of the year. Hopefully it was helpful. It's a mess out there is really kind of what it is for now. It is a mess out there. We could start to see some improvement. We're going to start to see improvement, it likely will be concentrated in tech to start with, based on the scores of the sectors that we've looked at. But even if we see improvement, don't forget that going forward, that this active signal in front of us, the 10-year 3-month spread, is now actively in play. And just leave a little bit of dedicate 0.1% of your total brain power to that. Just in your memory bank, just kind of keep it in there. We won't talk about it again for some time until we need to again. But that is the view here for the video. So I hope this was helpful, guys. I appreciate you. Happy New Year. And I look forward to trading with you guys this year. It's going to be fun. I don't expect it to be just a straight up ride like it was last year, but that also means that there should be a lot more volatility. And from a lot more volatility, if you're prepared for that, volatility is just another word for opportunity. So let's all do our work. Let's work together as a team. Let's hold each other up. And I'll see you guys next week. Cheers.